right, it is Monday and welcome back. I just made another purchase for my dividend portfolio that is up to a little over $8,000 right now. And I'll show you all just so I can show that, I don't just talk this thing, I actually do it. I actually purchase the things that I talk about that are good investments. So there, you can see it. I hope you can see that. That is my dividend portfolio as of right now. It's a little over $8,000. And the purchase that I just made, we're going to go over it right here today. We're talking about VIG, right? VIG. What is VIG? Well, it's the Vanguard Dividend Appreciation ETF. Wow, that's a lot to say. But the Vanguard Dividend Appreciation ETF, just like any other ETF, it has a basket of stocks within it, right? And that is the main selling point of an ETF. It is what is inside of this thing. What are we talking about as far as the businesses, the companies, and the things that make this thing tick on a daily basis in the stock market? Well, let's take a look at it and let's see if VIG is an ETF that you may want to add into your portfolio, or maybe you want to pass on it. But let's see. All right. So we're going to go for this data. We're going to use a couple things so I can explain exactly what's going on here. But if you have been following this channel, or if you've been following me, you know that one of my favorite all-time places to go for data and information is the free network, the free website, stockanalysis.com. And that's what I have pulled up right now. You see the overview. I'm just going to slide right over to the max chart. So all time, you can see that is a beautiful uptrend established back in May of 2006. I believe, yes, back in May of 20, maybe earlier. But yeah, so May of 2006. And since then, it has done nothing but perform. You're looking at a return of over 256% all time since its conception. That is absolutely what we want to see. And within this, there are 343 different holdings. You can see it right there. That's another reason why I love stock analysis, because all the data is kind of just right here in front of you. You don't have to really search for it. It's all really up front. I do love their interface. All right. Again, this is not an ad. They're not paying me to tell you all this or to share this information with you. I just like to share information that I think could be helpful. So you see 343 holdings within this particular ETF. And when we go and click on the holdings tab, you can see the first 10, the top 10, which are the assets that are weighted, the most heaviest weighted, or the assets that they own the most of, or that make up the most, or the bulk of the weight of this ETF is right up front. So at the top at number 1, you've got Microsoft. We all know Microsoft, right? Number 2, Apple. Number 3, Broadcom. Number 4, JP Morgan Chase and Company. Number 5, ExxonMobil. Number 6, United Health Group. 7, Visa. 8, MasterCard. 9, The Home Depot. And 10, Procter & Gamble. And you can see right there at 11 is Johnson & Johnson. Now, a lot of these is going to sound pretty familiar, right? A lot of these may even sound like the last video that I did, which on the last ETF that I did, because a lot of these are within multiple ETFs as being the most weighted items or businesses that they have. But look at all of the business that they have in this top 10, even 11. These are all profitable, well-known, wide moat companies. When we talk about wide moats, we're talking about companies that have the history and they have the dollars, right? They have the financials to support longevity. And they've been profitable for a very, 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 very long time. Warren Buffett often talks about how he likes to invest in companies that have wide moats. Why? Because companies with wide moats are proven. They're proven, right? They're historically proven to be financially beneficial to the investor. So that is what we're talking about. And that is definitely the case with all 11 of these top companies here. I love the fact that they have Visa and MasterCard in here. Visa being the number one the number one credit card application in the U.S. In the U.S., Visa is number one, meaning that is the card that most of everybody has in their wallet. Okay, most of us, they're saying, are all in debt to Visa. And I told y'all before, why not get Visa to pay you back some of that money, right? Why do we want to be in a position of where we just keep shelling out money over and over and over again? And we spending money and we swiping the card and we swiping our Visa card and we're buying this online and we're purchasing that online. Why not invest in Visa and get them to return you back some of that capital that we've all spent, apparently, on their business? So I love that Visa and MasterCard are in there, because Visa and MasterCard are two companies that will be around for the foreseeable future. Why? Because we owe them. Because Americans owe them. They are not going anywhere. Americans owe them. All right? So, the Home Depot, love it. Love to see it. Another great company. Johnson & Johnson. We all know about Johnson & Johnson. Merck & Company at number 12. Costco at number 13. AbbVie, love AbbVie at number 14. Number 15, Bank of America. 16, Walmart. Love Walmart. Walmart's not going anywhere. Why? Because the recession, Walmart is one of those recession-proof companies. All right. They're established. They've knocked off most of your neighborhood stores, the mom and pops grocery stores. Unfortunately, Walmart has come in and taken over. But hey, that is pretty much business. That's where we are. That's what happens. You get bought out or you get pushed out by the big dog on the block. Number 17, Pepsi. Number 18, Coca-Cola. Number 19, Lind. And number 20, Accenture. I love Accenture too. Accenture, by the way, is another stock that I did a video on last year. Okay, and Accenture was one of my choices for another recession-proof stock to own in your portfolio. I might end up doing another video on Accenture. I might even end up doing another recession-proof series, seeing as how we are still in the midst of a downturn economically and in the stock market. MCD, McDonald's at number 21. Y'all know how I feel about McDonald's. So listen, man, this is just a solid list. And today I went ahead and invested $10. Okay, wasn't a whole lot of money. And that's the thing that I need us to understand. You don't have to have a whole lot of money to invest. I know that the stock price is looking at $177. Listen, that's a hefty price to pay. Okay, for most of us, that is a hefty price to pay for one stock up front. I get it. I work. I understand. I live life just like y'all do. I go to work just like y'all do. I have bills just like y'all do. I get it, right? I have children too. So I understand that children are a separate expense. I said all that to say, I understand that you might not have the entire thing to invest up front, but why not throw in what you can and start building up and building up? No one's stopping you from doing that. And with these platforms now, again, I've said it before and I'll say it again. I'll say it till I'm tired in the face. You can invest as little as $1 to start your investing. It's all about starting. It's all about getting started, staying focused, and staying the course. Don't worry about everything else. Just stay the course. Come up with a game plan, your investing game plan, and execute on a daily or weekly, monthly basis, depending on and according to your financials. But listen, I invested $10 today into VIG. I get excited when I add a position to my portfolio. I do. I get excited, right? Because I can see everything and how it comes out in the wash. I also added to my dividend app that is tracking all of my dividends from this portfolio, this particular portfolio anyway. And I just get excited. Looking at that data, seeing that data and what it's going to yield me over the course of the year, I get excited adding new positions. But listen, VIG, this ETF, if you want something that I think is a recession-proof ETF, something to add to your portfolio to where you get a nice, healthy basket of stocks that are proven, companies that have been around forever and that will be around for the foreseeable future, then you need to check out VIG, okay? Let's go into the dividends. Dividend yield is 1.83%. That's an annual dividend of $3.23. You go down here and you can see what they've been paying out. Now, one thing you might notice here, this is a quarterly dividend stock, by the way. They pay out quarterly. One thing you might notice here is that the cash amounts that they've paid out over the past couple months and years has fluctuated. It's fluctuated, right? Now, you may be wondering, like, why is that? Why is the dividend fluctuating? But you'll find that that's often the case with an ETF. That's something that people don't really know, or people don't really research or look into or understand. ETFs dividends will fluctuate because why? You don't own just one company. It would be different if it was one company and the dividends were fluctuating every single month. You're like, okay, wait a minute, what is going on, right? That's not the case here. Here, and I'm going to show you. I want to see right here, it says, understanding that dividend payments can fluctuate. And here's why. I'm going to read a little bit of this. Many companies that pay dividends will do so by issuing a fixed amount on a quarterly basis. That amount usually remains consistent for 4 consecutive quarters when policy decisions get revisited and potentially changed. Dividend ETFs, however, work a little differently. Because they are baskets of dividend stocks and those stocks may get bought and sold all throughout the year, dividend amounts can change quarter over quarter or even month over month for certain ETFs. That doesn't necessarily make a dividend ETF bad. It's simply part of the process of owning a portfolio of stocks instead of individual names. In many dividend ETFs, the fluctuations shouldn't be significant, especially in more dividend growth-oriented strategies, but it's something investors should be aware of when investing in these products. And I think you should be aware of it because if you're depending on, just say, if you only wanted to invest in VIG, okay, let's say you only wanted to add VIG to your portfolio and rely on that for dividends. Well, it's going to be a little bit more difficult if you're depending on this type of ETF to supply you with dividends in retirement, right? Because you can't necessarily depend on a fixed amount every quarter. So I think that's important when you're considering this particular ETF. And for you, it could be a negative. You know, you might want something to where you can depend on the stability of knowing exactly what your payout is going to be. But you're not going to get that with the ETF. However, what you sacrifice with your dividends, right, with that fluctuation, that dividend fluctuation, you gain hopefully through the growth of the actual ETF because of the basket of stocks that are held within it. So you're looking at that capital appreciation of the stock itself. Hopefully that's a nice trade-off, for you, because you still get both. You still get the growth. You're still getting the growth of the ETF because of all of the large cap companies, successful companies that are within it, that are inside of it. So you're getting the growth. You're seeing the appreciation growth of those, the capital returns. But you're also getting the dividends, right? You're also getting a dividend and a respectable dividend. You're getting a respectable dividend in return while holding these growth companies, right? These large cap companies. So you're getting the best of both worlds, in my opinion. You're getting the best of both worlds with this particular ETF. I do want to read this part here where it says additional risks within dividend ETFs. It says the other primary risk can be understanding the payout landscape for different ETFs. Dividend growth ETFs may have payout schedules that are more stable, but also potentially come with smaller increases year over year. This can be because dividend growth stocks tend to be backed by durable companies that are more mature in nature and aren't growing nearly as fast. So, while you do get the appreciation of the businesses, right? The Home Depots, the Johnson & Johnsons. These aren't startup companies, right? In other words, they're saying you're going to see growth with these companies. They're going to continue to grow. But however, it's not going to be the same growth that you would see with a startup company, say as Tesla, right? You're not going to see a boom, really, in their growth charts because these are already established companies, and it's hard for companies like Coca-Cola to continue to grow at an exponential rate over the years. Why? Because they've already grown so much and built up their business so much over the course of the last years and decades, right? So they're saying you might not see that that incredible growth that you would with another company, but again, it's a trade-off because you're investing in a company that is stable. High yield ETFs, on the other hand, can be tempting because of their above average yields, but they may also be more unstable. Some high yields are due to significant share price declines that can, one, indicate a company is not performing well, and or two, a dividend cut may be ahead. There are positives and negatives to both approaches, and balancing out holdings targeting both strategies could help limit your risk. All right. And listen, that's pretty much it for this one. I do want to say, as we close out here, this company, of course, this is managed by Vanguard. Vanguard is a well-known company. So if you have any, I don't know, if you have any thoughts or negative thoughts about who you're investing with, you have nothing to worry about with Vanguard. I actually have a Roth IRA with Vanguard that I opened up, so I invest with them in multiple ways. Listen, check out VIG. It's along the lines of VYM, which I just did a video on, and you can go check that out as well. But listen, there's literally a basket of ETFs out there for everyone, all right? So if you're interested in any of the stocks that I mentioned here today within this ETF, I think that you should go ahead and check out VIG. And I'll see you all in the next video later. Thanks for watching.